The New Market Wizards, Conversations with America's Top Traders by Jack D. Schwager. Book Summary in English. Part 1, Trading Perspectives. Chapter 1, Misadventures in Trading. In the introductory chapter, Misadventures in Trading, Jack D. Schwager candidly reveals his personal struggles and significant errors as a trader. Rather than immediately presenting the success stories of the market wizards, Schwager uses his own experience to illustrate the common pitfalls and psychological traps that can derail even intelligent individuals in the markets. He details instances where he lost money due to a variety of factors, trading with scared money, capital he couldn't afford to lose, leading to heightened anxiety and poor decisions, lacking a well-defined trading plan, allowing emotions like fear and greed to dictate his actions, and holding on to losing trades too long while cutting winners short. Through these personal anecdotes, Schwager sets the stage for the rest of the book, implicitly highlighting the crucial psychological discipline and sound risk management practices that distinguish consistently successful traders from those who struggle. This chapter serves as both a relatable confession and a foundational lesson on the behavioral challenges inherent in trading. Key takeaways. 1. The peril of scared money. Trading with capital that is essential for living expenses or carries significant emotional weight inevitably leads to poor decision-making, e.g., exiting winners too early, holding losers too long, hesitation to take good trades. 2. Importance of a defined trading plan. Impulsive trading without clear rules, entry-exit points, and risk parameters is a recipe for inconsistency and losses. 3. Emotional control is paramount. Fear, greed, hope, and indecision are powerful forces that can override rational judgment and systematically undermine profitability. Recognizing and managing these emotions is critical. 4. Acceptance of losses. Losses are an inherent and unavoidable part of trading. The inability to cut losses quickly and accept them as part of the game is a major source of trading failure. 5. Risk management is non-negotiable. Proper position sizing and protecting capital are more important than seeking huge wins. Understanding and managing downside risk is fundamental to long-term survival and success. 6. Discipline. Overgenius. Consistently applying sound principles and adhering to a trading plan, even when challenging, is far more effective than relying on market predictions or fleeting intuitions. 7. Humility and learning from mistakes. Schwager's willingness to share his own errors emphasizes that even seasoned market participants make mistakes, but the key is to learn from them and adapt rather than repeat them. Chapter 2. Hussein Makes a Bad Trade. Hussein Makes a Bad Trade is a gripping short narrative that details the rapid and catastrophic downfall of a trader named Hussein, who finds himself entangled in a losing foreign exchange, Forex, position. The chapter opens with Hussein taking what he believes is a well-reasoned trade based on a fundamental view that the dollar will rise against the yen. However, the market immediately moves against him. Instead of adhering to a predefined stop-loss or re-evaluating his thesis, Hussein becomes increasingly stubborn and emotional, driven by a combination of hope, pride, and the desperate desire to avoid realizing a loss. He doubles down on his losing position multiple times, averaging down, ignoring all warning signs and sound risk management principles. He rationalizes his actions, convincing himself that the market must eventually turn in his favor. As the losses mount, his anxiety and desperation escalate, leading to impulsive and irrational decisions, such as neglecting sleep and making increasingly large, illiquid trades. The narrative vividly portrays the psychological agony of being trapped in a spiraling losing position and the self-deception that accompanies it. Ultimately, Hussein faces a margin call and is forced to liquidate his entire position at a massive loss, virtually wiping out his trading account. Key takeaways. 1. Ignoring stop losses is fatal. Hussein's primary mistake was his refusal to honor a predetermined stop loss. This highlights that having an exit strategy and executing it is paramount, regardless of one's conviction. 2. The danger of averaging down on losers. Adding to a losing position, averaging down, significantly escalates risk and is almost always a perilous strategy, driven by hope rather than objective analysis. 3. Stubbornness and pride lead to ruin. Hussein's ego prevented him from admitting he was wrong and cutting his losses. Pride often blinds traders to reality and makes them cling to losing trades. 4. Emotional trading is destructive. The narrative vividly shows how fear, hope, and desperation led Hussein to abandon all rational thought and sound trading principles, resulting in a complete meltdown. 5. Rationalization masks. Reality. Traders often rationalize their poor decisions, convincing themselves that the market must conform to their view, rather than accepting that their initial analysis might be incorrect. 6. Escalating risk is a death spiral. As losses mounted, Hussein compounded his errors by taking on even larger and more illiquid positions, accelerating his demise rather than mitigating it. 7. The market is always right. The market doesn't care about a trader's opinion or account balance. Resisting the market's direction is a losing battle. 8. The importance of psychological fortitude. The story implicitly emphasizes the need for strong mental discipline, emotional detachment, and the ability to accept being wrong in trading. Part 2. The world's biggest market. Currencies FX. Chapter 3. Bill Lipschutz, the Sultan of Currencies, from the New Market Wizards. Bill Lipschutz's interview in the New Market Wizards is a profound dive into the world of foreign exchange, FX trading, and the mindset required to succeed in it. Lipschutz, a legendary currency trader, began his trading career while studying at Cornell, making his first significant money by trading equities. However, his big break and subsequent fame came from his exceptional abilities in the FX markets, particularly during his time at Salomon Brothers, where he managed one of the firm's most profitable trading desks. Lipschutz emphasizes the importance of understanding market fundamentals and macroeconomics as the basis for his trading decisions, often combining this with technical analysis for entry and exit points. He discusses the critical role of risk management, highlighting the need to constantly monitor positions and be willing to cut losses. A recurring theme in his interview is the idea that successful trading is more about managing losing trades effectively than picking winners. He openly shares his own significant losses, including a period early in his career where a combination of overconfidence, large position sizing, and a stubborn refusal to admit error led to a devastating drawdown. This personal experience profoundly shaped his approach to risk. He stresses the necessity of being fully engaged and immersed in the market, having a deep understanding of market psychology, and recognizing when one's thesis might be wrong. Lipschutz also touches upon the challenges of scaling up trading operations, the importance of a team environment, and the psychological burden of managing substantial capital. He champions the idea of trading like a casino, understanding probabilities, and managing risk across a portfolio of trades rather than betting big on single outcomes. Key takeaways. 1. Macroeconomic and fundamental understanding is key. Lipschutz bases his trading decisions on a deep understanding of macroeconomic trends, political factors, and fundamental forces driving currency movements, rather than purely technical analysis. 2. Risk management above all else. His most powerful lesson is that the preservation of capital through stringent risk management, including proper position sizing and quick loss cutting, is more critical than generating large profits. He famously states that one of the secrets to trading is to lose less money. 3. Learn from significant losses. Lipschutz openly recounts a major drawdown early in his career due to overconfidence and poor risk management. This personal misadventure served as a foundational lesson, shaping his subsequent disciplined approach. 4. Managing losing trades is crucial. He emphasizes that truly successful traders distinguish themselves not by how well they pick winners, but by how effectively they manage their losing trades and limit their downside. 5. Market immersion and constant learning. Lipschutz highlights the need for continuous learning, staying connected to market information, and being deeply immersed in the dynamics of the market you are trading. 6. Trading like a casino, probabilistic thinking. He advocates for a probabilistic approach similar to a casino where one understands the odds and manages risk across a series of trades, rather than putting too much emphasis on any single outcome. 7. Emotional control and detachment. The interview implicitly and explicitly underscores the necessity of emotional discipline, avoiding hubris after wins, and remaining objective even during drawdowns. 8. The importance of liquidity and market structure. In FX, Lipschutz discusses the importance of understanding market liquidity, order flow, and the impact of large institutions. Part 3. Futures. The variety pack market. If we count futures, understanding the basics, as an introductory piece, then the next major section chapter would be The Silence of the Turtles. The Silence of the Turtles is not an interview with an individual trader, but rather a fascinating interlude within the book that delves into one of the most famous trading experiments in history, the Turtle Traders Experiment. Jack Schwager dedicates this segment to exploring the origins, execution, and implications of this groundbreaking project initiated by legendary futures traders Richard Dennis and William Eckhardt, who is interviewed later in the book. The core of the Turtle Experiment was to prove whether trading ability could be taught. Dennis famously asserted that he could take ordinary individuals with no prior trading experience and teach them to become successful traders by providing them with a specific set of rules and robust risk management principles. The experiment involved recruiting a diverse group of individuals, the Turtles, providing them with real trading capital, and instructing them on a specific trend-following system for futures markets. This chapter details the premise, Dennis's belief that trading was a skill that could be systematized and taught, rather than an innate talent. The recruitment, how the Turtles were selected through a rigorous application process. The training, the specific rules-based trend-following system they were taught, which included precise entry signals, position sizing, risk management, stop losses, and exit strategies. The results. While not every turtle was equally successful, the overall experiment was a resounding success, with many of the turtles generating extraordinary returns over several years, collectively earning over $100 million. The legacy. The enduring impact of the experiment, which demonstrated the power of a disciplined, systematic approach to trading and the critical importance of risk management and position sizing. Schwager uses this section to underscore the idea that a mechanical system, combined with strict discipline and adherence to rules, can outperform discretionary trading, especially for individuals who might struggle with emotional control. It also highlights the fact that highly profitable systems often require enduring significant drawdowns, which only discipline can overcome. Key takeaways. 1. Trading can be taught, systematized. The Turtle Experiment provided compelling evidence that successful trading is not solely an innate talent, but can be taught through a disciplined, rules-based system. 2. Rules-based approach is powerful. A clear, mechanical trading system with defined entry, exit, and risk rules can generate significant profits, provided it is consistently applied. 3. Discipline outweighs genius. The success of the Turtles, despite their varied backgrounds, underscored that strict adherence to a system and unwavering discipline are more crucial than superior intellect or intuition. 4. Risk management and position sizing are paramount. A core component of the Turtle system was meticulous risk management and position sizing. This allowed them to withstand losing streaks and maximize gains from winning trends. 5. Embrace drawdowns as part of the process. Trend-following systems inherently involve significant drawdowns. The Turtles' success depended on their ability to endure these periods by sticking to their system. 6. Trading psychology, implicit. While not explicitly a psychology chapter, the Turtle Experiment implicitly highlights the psychological challenges of sticking to a system, especially during losing periods, proving that emotional control is necessary even for mechanical trading. 7. The edge is in the system and execution. The turtle experiment demonstrated that a proven system, combined with precise execution, provides a sustainable edge in the markets. Monroe Trout, the best return that low risk can buy. Monroe Trout is an intriguing figure in The New Market Wizards because he represents a trading philosophy distinctly different from the high-octane, large-position traders. Trout, an MIT graduate with a background in mathematics, is known for achieving exceptional returns while maintaining an extraordinarily low level of risk. His approach is highly systematic, statistically driven, and rooted in an almost academic pursuit of identifying minor, persistent edges in the markets. Trout's method is characterized by emphasis on low risk and consistency. He prioritizes capital preservation above all else, aiming for consistent positive returns with minimal drawdowns. He demonstrates that significant long-term wealth can be accumulated through compounding small, steady gains. Statistical edge identification. His trading is based on extensive research and quantitative analysis to find small, recurring inefficiencies or patterns in market behavior across various futures markets. He looks for statistically verifiable edges, no matter how small. Diversification. Trout trades a very large number of markets simultaneously, which allows him to spread risk and ensure that even if one market goes against him, others might provide opportunities. This diversification is crucial to his low-risk profile. Mechanical and automated execution. His systems are highly mechanical, often automated, to remove human emotion and ensure precise execution of identified edges. Psychological detachment. He views trading as a game of probabilities and statistics, largely devoid of emotional attachment to individual trades. He understands that any single trade might lose, but over a large sample, his statistical edge will prevail. The slow and steady wins the race. Philosophy. Unlike some of the other wizards who describe aggressive, high-conviction trades, Trout's success comes from exploiting numerous small edges repeatedly, leading to very smooth equity curves. The interview highlights that superior returns don't always require taking massive risks. Sometimes, a relentless focus on a statistical edge, meticulous research, and disciplined, low-risk execution across many opportunities can yield impressive results. Key takeaways. 1. Low risk, high return is possible. Trout demonstrates that it's achievable to generate superior long-term returns even with a very low-risk approach by consistently compounding small gains. 2. Statistical edge is paramount. His trading is founded on rigorous statistical analysis to identify even tiny, persistent market inefficiencies. The edge doesn't have to be large, just reliable and repeatable. 3. Extensive diversification is key to stability. Trading a wide array of markets simultaneously helps to smooth out returns and reduce overall portfolio volatility, mitigating the impact of adverse movements in any single market. 4. Mechanical, emotion-free execution. Trout systems are highly systematic and often automated, eliminating human emotion and ensuring that every identified edge is exploited consistently. 5. Focus on capital preservation. His primary goal is to preserve capital, with profits being a secondary outcome of excellent risk management and consistent execution of his statistical edges. 6. Probabilistic thinking is essential. He views trading as a game of probabilities, accepting that individual trades will lose but trusting that his aggregate edge will lead to profitability over a large sample size. 7. Patience and persistence. Payoff. Success comes from patiently waiting for statistically valid setups and persistently executing them rather than seeking speculative home runs. Part 3. Futures. The Variety Pack Market. Chapter 4. Futures. Understanding the Basics. This chapter serves as a foundational primer on futures markets, authored by Jack Schwager himself, rather than being an interview with a specific trader. Its purpose is to equip the reader with the necessary background knowledge to understand the subsequent interviews with futures traders in Part 3. Schwager breaks down the complex world of futures into digestible concepts, explaining what futures contracts are, how they are traded, and their fundamental characteristics. Key topics covered include what a futures contract is, a legally binding agreement to buy or sell a standardized quantity of a specific commodity or financial instrument at a predetermined price on a specified date in the future. Types of futures, an overview of various futures markets including agricultural commodities, corn, wheat, energy, crude oil, natural gas, metals, gold, silver, financial futures, stock indices, interest rates, and currencies. Leverage, explaining how futures trading involves significant leverage, where a relatively small amount of margin controls a large notional value of the contract. Schwager highlights both the potential for amplified gains and the amplified risks due to leverage. Margin, the concept of initial margin, deposit to open a position, and maintenance margin, the minimum amount of equity required to keep a position open, and the dreaded margin call. Contract specifications, how contracts are standardized in terms of size, quality, delivery month, and trading hours, ensuring fungibility. Market participants, a brief discussion of who trades futures, hedgers, to mitigate risk, and speculators, to profit from price movements. Fundamental versus technical analysis in futures. While the book focuses on trader psychology, this chapter sets the stage for how both fundamental factors, supply, demand, economic reports, and technical analysis, chart patterns, indicators, play a role in futures price discovery. Risks, emphasizing the inherent risks due to leverage, volatility, and the potential for rapid price movements. Essentially, Schwager provides a clear, concise overview to ensure that readers understand the mechanics and unique aspects of the futures markets that the wizards discussed in this part of the book operate within. Key takeaways. 1. Futures are leveraged instruments. A small amount of capital, margin, controls a much larger notional value, meaning both profits and losses are magnified. 2. Standardization is key. Futures contracts have standardized terms, size, quality, delivery, making them highly liquid and tradable. 3. Margin requirements. Manage risk and create risk. Initial margin is required to open positions, and maintenance margin ensures that traders cover potential losses, leading to margin calls if account equity falls too low. 4. Hedgers and speculators drive the market. Futures markets exist for both hedging, risk mitigation, and speculation, profit-seeking, with both types of participants contributing to market liquidity. 5. Volatility and rapid price movements are common. Futures markets are often characterized by significant price swings, demanding quick decision-making and robust risk management. 6. Understanding basics is crucial for interviews. This chapter provides the necessary context for readers to fully grasp the strategies and challenges discussed by the futures traders interviewed in subsequent chapters. 7. Risk of loss is substantial. Due to leverage, it's possible to lose more than the initial margin deposited, highlighting the high-risk nature of futures trading. Chapter 5. Randy McKay, Veteran Trader. Randy McKay's interview presents a grounded and pragmatic perspective on trading, particularly in the futures markets. McKay is characterized as a seasoned, disciplined, and remarkably consistent trader who has navigated various market conditions over many years. His approach is less about grand theoretical frameworks and more about practical, real-world execution, emotional control, and a deep understanding of market flow. McKay emphasizes the importance of simplification and discipline in his trading. He doesn't rely on overly complex systems, but rather on identifying clear market trends and patiently waiting for high-probability setups. A key aspect of his philosophy is the importance of intuition developed through experience, but he cautions against letting intuition override clear signals or risk management rules. He talks about reading the market, understanding its underlying dynamics, and collective psychology rather than just relying on charts. A significant portion of his discussion revolves around risk control and loss management. McKay stresses the absolute necessity of cutting losses quickly and without hesitation. He views losses as an inevitable part of trading and believes that a trader's success is defined more by how they manage their losing trades than by their winners. He also touches on the psychological toll of trading, advocating for a balanced lifestyle and the ability to detach emotionally from trade outcomes. His long-term success is a testament to his consistent application of these fundamental principles. Key takeaways. 1. Discipline is paramount. McKay exemplifies the idea that strict discipline in following a trading plan and managing risk is far more critical than complex analysis or brilliant insights. 2. Cut losses ruthlessly. This is a recurring and central theme. He emphasizes the absolute necessity of quickly exiting losing trades to protect capital and prevent small losses from becoming catastrophic. 3. Simplicity and consistency. His trading style is not about complexity, but about consistently applying straightforward principles and waiting for high probability setups. 4. Market awareness and intuition, developed with experience. While disciplined, he also values a deep, intuitive understanding of market flow and psychology, developed over years of observation and trading. This intuition, however, must be tempered by rules. 5. Focus on risk management over profit-seeking. McKay's longevity and consistency stem from his primary focus on protecting capital. He believes that profits are a byproduct of excellent risk management. 6. Emotional detachment. He advocates for emotional detachment from trade outcomes, understanding that both wins and losses are part of the trading process and should not dictate future decisions. 7. Patience is a virtue. Waiting for the right opportunities and avoiding overtrading are critical elements of his disciplined approach. 8. Balanced perspective. He stresses the importance of a balanced life outside of trading to maintain mental clarity and avoid burnout. Chapter 6. William Eckhardt, the Mathematician. William Eckhardt is a pivotal figure in The New Market Wizards, not only for his insights into systematic trading, but also for his role alongside Richard Dennis in the famous Turtle Traders experiment. As the mathematician of the duo, Eckhardt brought a rigorous, analytical, and quantitative approach to trading. His interview dives deep into the philosophical underpinnings of systematic trading, the nature of randomness, and the psychological challenges of sticking to a system. Eckhardt emphasizes that a trading edge, while often small, must be statistically robust and consistently applied. He believes that markets, while appearing random in the short term, exhibit non-random behavior that can be exploited over a large number of trades. He's a proponent of rules-based trading and the idea that human emotions are the biggest impediment to consistent profitability. His perspective is deeply rooted in the concept of probabilistic thinking, understanding that any single trade is uncertain, but an edge exploited repeatedly across many trades will yield a positive outcome. A significant portion of his discussion revolves around position sizing and risk management, which he considers to be even more critical than the entry signal itself. He explains how proper position sizing allows a trader to survive inevitable losing streaks and capitalize on winning ones. He also touches on the psychological difficulties of enduring drawdowns and the self-deception that can arise when a trader deviates from their system. His ultimate message is that successful trading is a statistical endeavor, demanding unflinching discipline to execute a validated edge. Key takeaways. 1. Systematic and rules-based trading. Eckhardt champions a strictly systematic approach, believing that clear, objective rules are essential to eliminate emotional biases and ensure consistent execution of an edge. 2. Probabilistic thinking. Success in trading is a game of probabilities. Traders must think in terms of large samples of trades, understanding that an edge will only manifest itself over time, not in every single trade. 3. Edge exists in non-randomness. While markets appear random, Eckhardt believes there are underlying non-random patterns or biases that can be exploited if one has a statistically valid system. 4. Position sizing is paramount. More important than entry signals, according to Eckhardt, is how a trader sizes their positions relative to their capital and risk tolerance. This determines survival during losing periods and optimization during winning ones. 5. Human emotion is the enemy. He views emotions as the primary obstacle to consistent trading performance. A mechanical system helps to remove these detrimental influences. 6. Enduring drawdowns is part of the game. Even profitable systems experience losing streaks. Discipline is required to stick with the system during these periods, trusting the underlying statistical edge. 7. The goal is consistency, not perfection. Eckhardt's philosophy is about consistently exploiting small edges rather than seeking large, infrequent gains, leading to more stable equity growth. Chapter 7. The Silence of the Turtles. This chapter is a dedicated exploration of one of the most famous and influential trading experiments in history, the Turtle Traders Experiment. While not an interview with a single trader, it's a crucial interlude within the book, authored by Schwager, to highlight a powerful philosophy of systematic trading. The experiment was conceived by two legendary traders, Richard Dennis and William Eckhardt, whom we've just discussed. Dennis, a successful discretionary trader, famously bet Eckhardt that trading could be taught to anyone, regardless of their background. The chapter details how they recruited a diverse group of individuals, nicknamed Turtles, from various walks of life and with no prior trading experience. These individuals were put through an intensive training program where they were taught a specific, rules-based, trend-following system for trading futures markets. The system included precise instructions on entries, exits, and most importantly, position sizing and risk management. The turtles were then given real money to trade. The Silence of the Turtles showcases the remarkable success of this experiment. Despite initial skepticism, many of the turtles went on to generate extraordinary profits, collectively earning over $100 million. Schwager uses this narrative to underscore the profound power of a disciplined, mechanical approach to trading, emphasizing that strict adherence to a well-defined system and rigorous risk management can lead to consistent profitability, even for those without innate trading talent. It demonstrates that emotions are often the greatest impediment to trading success, and that a systematic approach helps to remove this obstacle. Key takeaways. 1. Trading is a teachable skill. The experiment provided compelling evidence that successful trading, particularly systematic trading, can be taught and is not solely reliant on innate talent or intuition. 2. Power of rules-based systems. A clearly defined, objective trading system with explicit rules for entries, exits, and risk is highly effective in generating consistent profits over time. 3. Discipline is paramount. The turtles' success largely stemmed from their unwavering discipline in adhering to the system, especially during inevitable periods of drawdowns or losing streaks. 4. Risk management and position sizing are foundational. The turtle system's emphasis on meticulous risk management and intelligent position sizing was crucial to its longevity and profitability, enabling traders to survive losing periods and maximize winning ones. 5. Emotional detachment is key. The mechanical nature of the system helped the turtles bypass emotional biases, fear, greed, hope, that often lead to poor discretionary trading decisions. 6. Acceptance of drawdowns. Trend-following systems inherently involve periods of significant losses or flat performance. The ability to endure these periods by trusting the system is vital. 7. Systematic approach versus discretionary trading. The turtles' success highlights the potential benefits of a systematic approach, especially for those who struggle with the psychological demands of discretionary trading. Chapter 8. Monroe Trout. The best return that low risk can buy. Monroe Trout's interview offers a distinctive perspective on trading, setting him apart from many of the other wizards. Trout, an MIT graduate with a background rooted in mathematics and statistics, exemplifies a highly systematic, quantitative, and risk-averse approach to the markets. His philosophy centers on generating consistent, positive returns with remarkably low volatility and minimal drawdowns, proving that significant wealth accumulation doesn't necessitate aggressive, high-risk strategies. Trout's success stems from his relentless pursuit of small, statistically validated edges across a vast number of diverse futures markets. He conducts extensive research to identify minor, repeatable inefficiencies in market behavior. His trading is largely mechanical and often automated, ensuring that emotion is removed from the execution process and that every identified edge is exploited consistently. He operates under the principle of extreme diversification, trading many different instruments simultaneously to spread risk and reduce the impact of adverse moves in any single market. He views trading as a probabilistic game, where success is achieved by consistently applying a statistically sound approach over a large sample of trades, rather than relying on the outcome of any individual trade. His interview underscores that superior returns can be achieved not through large, infrequent wins, but through the cumulative power of compounding many small, steady, and low-risk gains. Key takeaways. 1. Low risk, consistent returns. Trout demonstrates that it's possible to achieve exceptional long-term returns while maintaining an extremely low-risk profile and minimal drawdowns. 2. Statistical edge is paramount. His trading relies on rigorous quantitative analysis to uncover and exploit small, recurring, statistically significant inefficiencies in market behavior. 3. Extreme diversification reduces volatility. By trading a very broad range of markets simultaneously, he significantly reduces overall portfolio risk and smooths out equity returns. 4. Mechanical and emotion-free execution. His systems are highly automated and rules-based, which eliminates human bias and ensures precise, consistent execution of his identified edges. 5. Capital preservation. First, Trout's primary objective is to protect capital. Profits are seen as a byproduct of meticulous risk management and disciplined application of his statistical methodology. 6. Probabilistic mindset. He understands that any single trade can be a loser, but over a large series of trades, his statistical edge ensures overall profitability. This allows for detachment from individual trade outcomes. 7. Patience and persistence. Success in this approach comes from patiently identifying valid setups and consistently executing them, illustrating that the slow and steady approach can yield powerful results. Chapter 9. Al Weiss, The Human Chart Encyclopedia. Al Weiss stands out in the New Market Wizards as a trader who achieved remarkable success primarily through a deep, almost intuitive, understanding of technical analysis and chart patterns. Unlike some of the more quantitative or fundamental traders, Weiss embodies the power of visual market interpretation. His nickname, the Human Chart Encyclopedia, perfectly captures his ability to recall and recognize countless historical chart formations and understand how they might play out in current markets. Weiss's approach is characterized by mastery of chart patterns. He possesses an extraordinary ability to identify and interpret classic and subtle chart patterns, believing that these visual cues often reflect underlying market psychology and future price movements. Patience and waiting for the right setup. He stresses the importance of waiting for crystal clear, high probability patterns to emerge rather than forcing trades. His discipline lies in sitting on his hands until the market presents an undeniable opportunity. Focus on price action. While he might use some indicators, his core methodology revolves around pure price action, volume, and how markets interact at key support and resistance levels. Adapting to market conditions. Weiss understands that no single pattern works all the time. He emphasizes adapting one's approach to the prevailing market environment, e.g., trending versus range-bound markets. Risk management through pattern recognition. His stop-loss placements are often derived directly from the chart patterns themselves, Placing stops where the pattern is invalidated. Psychological edge from conviction. His deep understanding of patterns gives him the conviction to hold winning trades and cut losing ones because he knows what should happen if the pattern is valid. The interview reveals a trader who has honed his craft through immense screen time and meticulous observation, developing an almost photographic memory for market behavior. His story is a testament to the fact that profound understanding of price action, combined with discipline, can be a powerful edge. Key takeaways. 1. Technical analysis mastery. Weiss demonstrates that a profound understanding of technical analysis, particularly chart patterns and price action, can be a highly effective path to consistent profitability. 2. Patience is paramount. He emphasizes the critical importance of waiting for high probability setups and avoiding the urge to trade constantly. 3. Visual recognition of market psychology. His ability to recall and interpret numerous historical chart patterns allows him to anticipate future market behavior by recognizing recurring psychological dynamics. 4. Risk defined by pattern. Invalidation. Stop-loss levels are determined by the point at which the chosen chart pattern is invalidated, providing a logical and objective exit point. 5. Adaptability. Successful technical trading requires adapting one's approach to different market conditions, e.g., bull, bear, or sideways markets. 6. Discipline and execution. His success stems from the discipline to only take the clearest setups and to follow his predefined exit rules based on chart behavior. 7. Screen time and experience build intuition. Weiss's extraordinary ability is a result of years of dedicated observation and learning from countless charts, building an intuitive understanding that complements his technical rules. Part 4. Fund Managers and Timers. Chapter 10. Stanley Druckenmiller, The Art of Top-Down Investing. Stanley Druckenmiller is one of the most celebrated macro traders in history, renowned for his incredible long-term track record, particularly during his tenure managing George Soros's Quantum Fund. His interview offers profound insights into macro trading, emphasizing a top-down approach that combines deep fundamental analysis with keen market psychology and aggressive position sizing when conviction is high. Druckenmiller's methodology is characterized by macroeconomic analysis. He forms a broad, global macroeconomic view, identifying major trends in interest rates, currencies, commodities, and equities based on fundamental shifts. High conviction and aggressive sizing. When he has a strong conviction about a particular macroeconomic theme, he sizes his positions very aggressively. He doesn't believe in diversifying for the sake of diversification. Instead, he concentrates capital in his best ideas. Flexibility and adaptability. Despite his strong convictions, Druckenmiller is relentlessly pragmatic and willing to change his mind immediately if the market proves him wrong or if new information emerges. He doesn't let ego interfere with exiting a losing position. Focus on the big picture. He's always looking for the next major shift or sea change in the global economy or specific markets, rather than getting bogged down in minor details. Psychological readiness. He recognizes the emotional demands of managing large sums of money and taking significant risks. He emphasizes managing stress and ensuring one's mental state is conducive to optimal decision-making. Learning from mistakes. Druckenmiller is candid about his own significant errors, which serve as crucial learning experiences that refine his decision-making process. He highlights the importance of cutting losses quickly. His interview is a masterclass in combining rigorous fundamental analysis with a flexible, opportunistic, and conviction-driven trading style, all underpinned by strong risk management discipline. Key takeaways. 1. Top-down macro approach. Success stems from forming a comprehensive global macroeconomic view and identifying major fundamental shifts that will drive market trends. 2. Concentration and conviction. When conviction is high, Druckenmiller believes in concentrating capital aggressively into his best ideas, rather than broadly diversifying for its own sake. 3. Flexibility and willingness to change mind. Despite strong convictions, he stresses the absolute necessity of being pragmatic, admitting when you're wrong, and quickly reversing course if the market proves your thesis incorrect. 4. Cut losses relentlessly. A recurring theme among all wizards, Druckenmiller explicitly states the importance of cutting losses quickly and without hesitation. 5. Focus on the big picture. Don't get caught up in noise. Identify the major forces and long-term trends that offer significant profit potential. 6. Trading is an art of anticipation and adaptation. It's about anticipating shifts and positioning early, but also adapting swiftly when the market provides new information. 7. Emotional management for large capital. The psychological burden of managing vast sums requires strong emotional control and self-awareness. 8. Risk management is about capital preservation. His aggressive positioning is always balanced by an underlying discipline to protect capital, ensuring he can stay in the game after losses. Chapter 11, Serenity. Serenity is not an interview with a trader, but a very brief, poignant interlude written by Jack Schwager. It serves as a moment of reflection, breaking up the intensity of the trader interviews to emphasize a crucial psychological state for successful trading. The chapter consists of a few paragraphs that speak to the idea of inner peace, detachment, and a balanced mindset in the face of market volatility and the inherent uncertainty of trading. Schwager suggests that achieving a state of serenity, or emotional equilibrium, is essential for making clear-headed decisions and avoiding the pitfalls of fear and greed. It implicitly reminds the reader that success in trading isn't just about strategy. It's profoundly about managing one's own mental and emotional state. This piece serves as a philosophical breather, urging traders to cultivate a calm demeanor that allows them to observe the market objectively and execute their plans without emotional interference. Key takeaways. 1. Emotional balance is crucial. Achieving a state of serenity or inner calm is vital for rational decision-making in the turbulent world of trading. 2. Detachment from outcomes. Successful traders are able to detach emotionally from the immediate results of individual trades, focusing instead on the long-term process and probabilistic edge. 3. Mindset over mechanics. Often. This interlude underscores that even with the best strategies, a chaotic or anxious mind will likely lead to poor execution and suboptimal results. 4. The importance of inner state. It highlights that a trader's internal psychological state is as important as, if not more important than, their external market analysis. 5. Preparation for volatility. Cultivating serenity helps a trader remain objective and disciplined when faced with inevitable market fluctuations, drawdowns, and unexpected events. Chapter 12. Linda Bradford. Raschke. Reading the Music of the Markets. Linda Bradford Raschke is one of the most respected technical traders and system developers featured in the New Market Wizards. Her interview offers a refreshingly practical and intuitive approach to trading, emphasizing the feel for the market developed through extensive observation and experience. She is renowned for her ability to read short-term price action and identify subtle shifts in market rhythm, likening it to reading the music of the markets. Raschke's trading style is characterized by short-term focus. She primarily operates on shorter time frames, looking for quick, high-probability trades based on technical patterns and momentum. Mastery of technical patterns and price action. She utilizes a variety of chart patterns, oscillators, and indicators, but her true skill lies in synthesizing these tools with her intuitive understanding of market behavior. She's a master of identifying subtle setups based on how price and volume interact. Discipline and patience. Despite her short-term focus, she stresses the importance of waiting for precisely defined setups and avoiding impulsive trading. She emphasizes that good trading is often boring, involving a lot of waiting. Importance of execution. Raschke highlights that even a simple strategy, if executed with flawless discipline and proper risk management, can be highly profitable. Risk management as a core principle. She is very clear on setting stop losses and managing risk on every trade. She views losses as simply the cost of doing business and moves on quickly from them. Focus on market structure and rhythm. Her reading the music analogy refers to her ability to discern the underlying market sentiment, the dominant forces at play, and the typical patterns that tend to repeat themselves. Humility and continuous learning. She acknowledges the market's ever-changing nature and the need for traders to remain adaptable and open to learning. Her interview provides a compelling look into the mind of a highly successful technical trader who combines rigorous methodology with an acute sense of market flow and disciplined execution. Key takeaways. 1. Intuitive technical analysis. Success comes from a deep, almost intuitive understanding of price action and technical patterns, developed through extensive screen time and observation. 2. Discipline in execution. Even simple strategies can be highly profitable if executed with unwavering discipline and precise risk management. 3. Patience for high probability setups. Successful short-term trading is not about constant action, but about patiently waiting for clear, high probability patterns to emerge. 4. Risk management is non-negotiable. Strict adherence to stop losses and proper position sizing is fundamental to survival and long-term profitability. Losses are a cost of doing business, not failures. BINSF. Market rhythm and flow. Developing a feel for the market's underlying rhythm, sentiment, and structural tendencies is crucial for anticipating short-term movements. 6. Adaptability. Traders must remain flexible and adapt their approach as market conditions change, as no single strategy works in all environments. 7. Emotional detachment. The ability to detach emotionally from trade outcomes and treat trading as a business is essential for consistent performance. Part V. Multiple market players. Chapter 13. Gil Blake, the Master of Systems. Gil Blake's interview provides a compelling look into the world of systematic trading across diverse markets, emphasizing the power of rigorous research, multiple strategies, and robust risk management. Blake, a former mathematician, achieved exceptional returns by trading a variety of commodity futures and financial instruments using highly disciplined, automated systems. He is renowned for his ability to synthesize complex data and backtest extensively to find robust trading edges. Blake's approach is characterized by diversification of systems and markets. Rather than relying on a single trading system or market, he trades a portfolio of distinct systems across a wide range of uncorrelated markets. This diversification helps to smooth out returns and reduce overall portfolio volatility. Rigorous research and backtesting. He emphasizes the importance of meticulous research and extensive backtesting to validate trading ideas and ensure their statistical robustness. He is wary of curve fitting and seeks strategies that perform well across different market conditions. Focus on expectancy. Blake thinks in terms of positive expectancy, meaning that over a large series of trades, his systems are statistically designed to yield a profit. He understands that individual trades are merely iterations of this probabilistic edge. Emotional detachment through automation. A significant portion of his trading is automated, which helps to eliminate emotional biases and ensures consistent execution of his rules. Risk management as a core component of the system. Risk control, including position sizing and stop-loss placement, is integral to the design of his systems, not an afterthought. He structures his portfolio so that even a significant loss in one system or market doesn't jeopardize the entire capital. Patience and persistence. He highlights the need for patience to allow the long-term edge of the systems to play out, accepting that drawdowns and periods of underperformance are inevitable. Blake's interview underscores that systematic trading is a highly intellectual and disciplined endeavor, where the edge comes from diligent research, diversified application, and unwavering adherence to statistical principles. Key takeaways. 1. Portfolio of systems and markets. Diversifying across multiple independent trading systems and a wide range of uncorrelated markets is crucial for stable, long-term performance. 2. Rigorous research and statistical validation. Trading ideas must be thoroughly researched and extensively back-tested to ensure they have a statistically robust positive expectancy. Avoid curve fitting. 3. Probabilistic mindset. Success in systematic trading is about exploiting a statistical edge over a large number of trades, not about predicting individual trade outcomes. 4. Automation for emotional discipline. Automating trading systems helps to eliminate human emotion, ensuring consistent and objective execution of the rules. 5. Integrated risk management, risk control, position sizing, stops should be built directly into the trading systems, ensuring that capital is protected under all circumstances. 6. Patience. During drawdowns, even robust systems experience losing periods. Discipline requires trusting the research and sticking with the system during these times. 7. Focus on consistency over spectacular gains. Blake's success comes from the compounding of consistent, small to moderate gains generated by his diversified portfolio of systems. Chapter 14. Tom Basso, Mr. Serenity. Tom Basso, often referred to as Mr. Serenity, stands out in the New Market Wizards for his highly disciplined, systematic, and remarkably calm approach to trading. As the former president of Trendstat Capital Management, Basso achieved consistent success by trading a diverse portfolio of futures markets using entirely quantitative, rules-based systems. His interview emphasizes the importance of a tranquil mindset, robust methodology, and the power of diversified strategies. Basso's philosophy is deeply rooted in systematic and rules-based trading. He believes that consistent profitability comes from developing and strictly adhering to well-researched, mechanical trading systems. He explicitly states that emotion is the biggest enemy of trading, and that systems are designed to eliminate it. Diversification of systems and markets. Similar to Gil Blake, Basso champions running multiple, uncorrelated trading systems across a wide array of markets. This diversification smooths out equity curves, reduces overall portfolio volatility, and ensures that periods of underperformance in one system or market are offset by others. The importance of expectancy. He focuses on the positive expectancy of his systems over a large number of trades, understanding that individual trades are just random outcomes within a statistically profitable framework. Lifestyle and mental state. His Mr. Serenity moniker reflects his belief that a balanced, peaceful lifestyle and a calm mental state are crucial for effective trading and managing the stresses of the business. He emphasizes self-awareness and knowing oneself. Risk management as core. Basso meticulously builds risk management, including precise position sizing and stop-loss criteria, directly into his systems. He views drawdowns as an unavoidable part of the process and manages them systematically. Acceptance of the market. He advocates for accepting whatever the market gives you, without trying to force outcomes or predict every move. His focus is on reacting systematically to price action. Basso's interview is a testament to the power of combining a sound, diversified, systematic approach with an unshakable psychological disposition, leading to exceptional long-term consistency. Key takeaways. 1. Systematic trading for consistency. Develop and rigidly follow well-researched, rules-based trading systems to remove emotion and achieve consistent, long-term results. 2. Extensive diversification. Trade multiple, uncorrelated systems across a wide range of markets to smooth out returns and reduce overall portfolio risk. 3. Positive expectancy is the goal. Focus on the statistical edge of your system over many trades, understanding that individual trade outcomes are random. 4. Emotional control through systems. Systems are the best defense against emotional trading errors, fear, greed, hope. 5. Importance of mental well-being. A calm, balanced mental state and a healthy lifestyle are essential for effective decision-making and enduring the stresses of trading. 6. Rigorous risk management. Integrate precise position sizing and strict stop-loss rules directly into your trading systems. 7. Acceptance and adaptability. Accept market outcomes without emotional attachment and be willing to adapt your systems as market conditions evolve. 8. Learning from experience. Even with systems, continuous learning and refinement based on market feedback are crucial. Chapter 15. Victor Sperandeo. Markets grow old too. Victor Sperandeo, known as Trader Vic, is a highly respected professional trader and market theorist whose interview in The New Market Wizards focuses heavily on the concepts of trend analysis, risk management, and market cycles. Sperandeo is a strong advocate for a disciplined, systematic approach to trading that combines fundamental analysis with clear technical rules, particularly regarding trend identification and loss control. His famous 2B rule for identifying trend reversals is a hallmark of his technical approach. Key aspects of Sperandeo's philosophy include trend following and reversal identification. He places a strong emphasis on identifying and following major trends, but also provides clear rules, like his 2B rule, for spotting potential trend reversals, which he believes are crucial for entering and exiting positions effectively. Fundamental underpinnings. While heavily technical in his execution, Sperandeo stresses the importance of understanding underlying economic and fundamental factors that drive long-term trends. He believes successful trading combines a macro view with precise, technical entries, exits. Risk management as the cornerstone. Sperandeo is a fervent proponent of strict risk management. He emphasizes the importance of knowing your maximum loss on any given trade before entering it, and he advocates for rigorous position sizing based on that risk. He famously said, "The first rule of trading is, don't lose money. The second rule of trading is, don't forget the first rule." Market cycles and lifespans. His concept of markets grow old refers to his belief that trends, like living organisms, have distinct lifespans and stages of development, maturity, and decline. Understanding these cycles helps in identifying when trends are likely to end. Discipline and emotional control. He consistently underscores the need for unwavering discipline to execute trading rules without emotional interference, especially when cutting losses, the power of compounding small gains. Sperandeo believes that long-term wealth is built not through spectacular gains, but through consistent, well-managed trades that compound over time. His interview offers a blend of theoretical insight into market behavior and practical, actionable rules for disciplined trading. Key takeaways. 1. Strict risk management is non-negotiable. Define your maximum loss before entering any trade and adhere to it without exception. Protecting capital is the primary goal. 2. Trend identification and reversal rules. Master the art of identifying prevailing trends and employ clear, objective rules, like the 2B rule, to spot potential trend reversals for timely entries and exits. 3. Combination of fundamental and technical analysis. Best results are achieved by understanding the fundamental drivers behind major trends and then using technical analysis for precise timing and risk control. 4. Markets have lifespans. Trends, like living organisms, go through predictable cycles of birth, growth, and decay. Recognizing these cycles is key to profiting from them. 5. Discipline is key to execution. No system or insight is valuable without the discipline to execute it flawlessly, especially when it comes to cutting losses. 6. Avoid catastrophic losses. The ultimate goal is to avoid major setbacks that can wipe out capital. Consistent small gains compounded over time lead to significant wealth. 7. Humility and adaptability. Be humble enough to admit when you're wrong and adapt your views as market conditions and fundamentals change. Part 6. The Money Machines. Chapter 16. CRT, the Trading Machine. DRT, the Trading Machine, focuses on the innovative and highly successful Chicago Research and Trading Group, CRT, a pioneering proprietary trading firm that was a major force in the options and derivatives markets. Unlike the individual trader interviews in previous chapters, this segment delves into the structure, philosophy, and operational genius of a highly organized, systematic, and technologically advanced trading entity. CRT was known for its cutting-edge quantitative models, sophisticated risk management systems, and a culture that fostered collaboration and intellectual rigor. The chapter explains how CRT operated like a money machine by arbitrage and market making. Their core business was primarily in arbitrage strategies, exploiting small pricing discrepancies between related instruments, e.g., options and their underlying assets, and acting as market makers, providing liquidity and profiting from the bid-ask spread. Quantitative modeling. CRT relied heavily on sophisticated mathematical models to price derivatives, identify mispricings, and manage risk. This was long before such quantitative approaches became mainstream. Technology and automation. They were early adopters of technology to analyze data, execute trades, and manage positions at speed and scale, providing a significant edge. Systematic risk management. With so many positions and complex strategies, their survival depended on extremely robust, real-time risk management systems that monitored exposure across their entire portfolio. Team-based approach. Unlike the lone wolf image of many traders, CRT fostered a collaborative environment where research, strategy development, and risk oversight were shared responsibilities. Process over prediction. Their success wasn't about predicting market direction, but about exploiting statistical edges and managing risk systematically across a high volume of trades. Recruitment and training. CRT was known for hiring brilliant minds, often with science or math backgrounds, and training them rigorously in their proprietary methods. This chapter provides a glimpse into the evolution of institutional trading, highlighting how sophisticated quantitative methods, technological prowess, and systematic risk control can create a powerful and consistently profitable trading operation. Key takeaways. 1. Institutional trading power reveals how a structured firm can achieve remarkable success through collective expertise, quantitative analysis, and systematic processes. 2. Arbitrage and market making demonstrates the profitability of exploiting pricing inefficiencies and providing liquidity through arbitrage strategies, particularly in options and derivatives. 3. Quantitative and model-driven approach highlights the critical role of sophisticated mathematical models and rigorous quantitative research in identifying edges and managing complex positions. 4. Leveraging technology showcases how advanced technology and automation were key to CRT's ability to analyze vast amounts of data, execute trades rapidly, and maintain a competitive edge. 5. Robust risk management systems emphasizes the absolute necessity of comprehensive, real-time risk management for high-volume, complex trading operations to prevent catastrophic losses. 6. Team-based collaboration. Success can come from a collaborative environment where individual talents are pooled for research, strategy, and oversight, rather than solely relying on individual genius. 7. Process-oriented trading. Success is about consistently applying a well-defined, systematic process to exploit edges, rather than making directional bets or predicting specific market moves. Chapter 17. Mark Ritchie, God in the Pits. Mark Ritchie's interview provides a vivid and often spiritual perspective on trading, particularly from the vantage point of a floor trader in the futures pits. Unlike many of the systematic or macro traders, Ritchie's success was deeply intertwined with his presence on the trading floor, his intuitive understanding of market psychology, and a unique blend of technical analysis, fundamental awareness, and a strong spiritual grounding. His nickname, God in the Pits, speaks to his seemingly uncanny ability to navigate and profit from the chaos of open outcry trading. Ritchie emphasizes intuition and market feel. He talks extensively about developing an intuitive feel for the market's pulse, understanding the collective emotions of the pit, and recognizing subtle shifts in supply and demand based on human interaction, the importance of patience and discipline. Despite the fast-paced pit environment, Ritchie stresses the need for patience to wait for the right opportunities and the discipline to stick to one's convictions. Risk management and survival. He's a strong advocate for capital preservation, recognizing that trading is fundamentally about survival. He shares his own past mistakes, including major losses from overconfidence and failing to respect risk. Spiritual and mental well-being. A unique aspect of his interview is his belief that a trader's inner peace, morality, and spiritual health significantly impact their trading performance. He links emotional control and clarity directly to one's broader life perspective. Adaptability. Ritchie highlights the need to adapt to changing market conditions and not cling to old ideas or methods. Technical analysis, simplified. While on the floor, his technical analysis was often quick and visual, focusing on key levels, patterns, and immediate market reactions. His story is a powerful reminder that trading success can come from diverse paths, often combining sharp analytical skills with a profound understanding of human behavior, and, in Ritchie's case, a strong personal philosophy that informed his disciplined approach. Key takeaways. 1. Intuitive market understanding. Success can stem from developing an acute feel for market dynamics, particularly in a high-intensity environment like the trading pit, by observing human behavior and collective psychology. 2. Discipline amidst chaos. Even in a frenetic environment, disciplined waiting for high-probability setups and adherence to risk parameters are crucial. 4. The link between interstate and trading. A trader's emotional, mental, and even spiritual well-being can profoundly impact their ability to make rational decisions and manage risk effectively. 5. Adaptability to changing conditions. Markets are dynamic, and traders must be willing to adapt their strategies and mindset to new realities. 6. Psychological edge from humility and self-awareness. Ritchie's narrative implies that recognizing one's limitations and consistently working on self-improvement are vital for longevity in trading. Chapter 18, Joe Ritchie, the Intuitive Theoretician. Joe Ritchie's interview presents a fascinating contrast and complement to his brother Mark. While Mark was known for his intuitive feel in the pits, Joe, a former options market maker and co-founder of the highly successful trading firm Ritchie Capital Management, is characterized as an intuitive theoretician. He combines a deep, almost philosophical understanding of market dynamics with a practical, systematic approach to identifying and exploiting trading edges. Ritchie's insights are centered on defining the edge. He emphasizes that the absolute first step for any trader is to precisely define their edge, what makes them systematically more likely to profit than lose. This edge isn't just about market direction, but often about exploiting subtle statistical advantages or structural inefficiencies, probabilistic thinking, and positive expectancy. Like William Eckhardt, Ritchie thinks rigorously in terms of probabilities and mathematical expectation. He views trading as a series of bets where, over time, a positive expectancy will lead to profits, even if individual trades are losing. Option theory and volatility. Given his background, he delves into options trading concepts, explaining how he uses volatility models and other theoretical frameworks to identify mispricings and build profitable strategies. Risk management as an integral part of the system. For Ritchie, risk management isn't a separate function, but is deeply embedded in the design of his trading strategies. He meticulously quantifies and limits his maximum potential loss on any given strategy or trade. Intuition guided by theory. While highly analytical, Ritchie also acknowledges the role of intuition. However, for him, intuition isn't a gut feeling detached from logic. It's an informed intuition built on a deep understanding of market theory and experience. The importance of learning from losses. He candidly discusses past failures and how they served as crucial learning experiences, leading to refinement of his trading philosophy and risk controls. Process over outcome. He highlights the importance of focusing on the soundness of the trading process and execution, trusting that good process will eventually lead to good outcomes, rather than fixating on immediate trade results. Joe Ritchie's interview provides a sophisticated perspective on trading, blending theoretical rigor with practical application and an unwavering commitment to understanding and managing risk. Key takeaways. 1. Clearly define your trading edge. The absolute prerequisite for consistent trading success is to understand precisely what gives you a statistical advantage in the market. 2. Embrace probabilistic thinking. Trading is a game of probabilities. Focus on the positive mathematical expectation of your system over a series of trades, not on the outcome of any single trade. 3. Risk management is systemic. Risk control should be an intrinsic part of your strategy design, not an afterthought. Quantify and limit potential losses at the outset. 4. Informed intuition. Develop intuition through deep theoretical understanding and extensive experience, allowing it to guide, but not override, systematic decision-making. 5. Focus on the process. Prioritize executing a sound trading process with discipline, trusting that positive outcomes will follow over the long run. 6. Learn rigorously from mistakes. Past trading errors are invaluable lessons that should lead to fundamental improvements in one's approach and risk controls. 7. Sophisticated use of theory. Leverage theoretical frameworks, e.g., options pricing, statistical models, to identify and exploit subtle market inefficiencies. Chapter 19. Blair Hull, Getting the Edge. Blair Hull's interview is a powerful testament to the application of quantitative analysis, statistical arbitrage, and a relentless pursuit of a defined mathematical edge in trading. Hull, a former professional blackjack player who later became a highly successful options and derivatives trader and founder of Hull Trading Company, which was eventually sold to Goldman Sachs, epitomizes the transition from intuitive trading to highly systematic and automated approaches. His background in gambling provided him with a unique perspective on probabilities and risk. Key aspects of Hull's philosophy and success include statistical arbitrage and edge identification. Hull's entire career is built on identifying and systematically exploiting tiny, statistically verifiable pricing discrepancies or inefficiencies in the markets, particularly in options. He didn't predict direction. He found situations where the odds were tilted in his favor. Mathematical and computational prowess. His firm was at the forefront of using sophisticated mathematical models and advanced computing power to analyze vast amounts of data, identify arbitrage opportunities, and execute trades at high speed. Relentless pursuit of information. He emphasized that getting the edge often means being faster and smarter at acquiring and processing relevant market information. This could involve physical proximity to the exchange, superior data feeds, or more efficient algorithms. Disciplined risk management. Despite dealing with complex instruments, Hull maintained strict control over risk by meticulously quantifying potential losses and employing sophisticated hedging strategies. He understood that even small edges need to be managed through position sizing, team-oriented environment. Like CRT, Hull trading was a collaborative environment where top quantitative minds worked together to develop and refine trading systems. Automation and removal of emotion. His trading was largely automated to ensure consistent execution of his models and to eliminate human emotional biases that could erode his statistical edge. The gambling analogy. His background in blackjack instilled in him a deep understanding of probability, expected value, and money management, concepts directly transferable to trading. Blair Hull's story is a compelling illustration of how rigorous quantitative analysis, technological innovation, and an unwavering focus on a mathematically defined edge can lead to extraordinary success in the most competitive markets. Key takeaways. 1. Find a statistical edge. Success in trading is about identifying and systematically exploiting small, quantifiable statistical advantages or inefficiencies in the market. 2. Mathematical and computational rigor. Leverage advanced mathematical models and powerful computing resources to analyze data, identify opportunities, and execute trades with precision and speed. 3. Information is power. The ability to acquire, process, and act on relevant market information faster and more efficiently than competitors is a significant source of edge. 4. Systematic risk management. Robust risk control, including sophisticated hedging and position sizing, is crucial for exploiting small edges across a large volume of trades without catastrophic losses. Automation for discipline. Automating trading strategies helps to eliminate emotional errors and ensures consistent, unbiased execution of the defined edge. 6. Probabilistic thinking from gambling. A background in games of chance, like blackjack, instills a crucial understanding of probability, expected value, and money management that is directly applicable to trading. 7. Team collaboration for complexity. For highly complex quantitative strategies, a team of brilliant minds working collaboratively often outperforms individual efforts. Chapter 20. Jeff Yass, The Mathematics of Strategy. Jeff Yass, a co-founder of Susquehanna International Group, SI.G., is presented as a brilliant and intensely competitive options trader whose success is built on a deep understanding of probability, game theory, and the rigorous application of mathematical principles to trading. His interview highlights how a formal, analytical approach, combined with a highly disciplined team environment, can exploit subtle market inefficiencies. Yass, like Blair Hull, also has a background in professional gambling, which profoundly shaped his probabilistic mindset. Key aspects of Yass's philosophy and SIG's success include game theory and probabilistic thinking. Yass's entire approach is rooted in understanding the underlying probabilities of market events and making decisions based on expected value, much like a professional poker player. He doesn't just trade. He plays the market like a strategic game. Systematic edge identification. SIG's strength lies in its ability to mathematically define and systematically exploit statistical edges, particularly in the complex world of options and derivatives. They don't predict market direction, but rather look for situations where the odds are skewed in their favor. Team-based and collaborative environment. Unlike the lone wolf trader, SIG emphasizes a highly collaborative, intellectual environment where traders are encouraged to think rigorously, share ideas, and constantly challenge assumptions. This collective brainpower is a key advantage. Information advantage. Yass stresses the relentless pursuit of superior information and its efficient processing. This includes understanding the nuances of how information affects prices and using technology to gain an edge in speed and analysis. Rigorous risk management. Given the high leverage and complexity of options, SIG's success hinges on meticulous risk management, understanding the Greeks, delta, gamma, theta, vega, and dynamically adjusting hedges to control exposure. Learning and continuous improvement. There's a strong emphasis on learning from every trade, analyzing mistakes, and constantly refining their mathematical models and trading strategies. No holy grail. Yass understands that edges are often fleeting. The challenge is to constantly find and exploit new ones. Jeff Yass's interview provides a powerful example of how intellectual rigor, probabilistic thinking, advanced mathematics, and a highly organized team can consistently extract profits from complex financial markets. Key takeaways. 1. Probabilistic thinking is foundational. Approach trading as a game of probabilities and expected value, rather than trying to predict precise market movements. 2. Define and exploit mathematical edge. Success comes from rigorously identifying and systematically exploiting mathematically quantifiable edges, especially in derivatives pricing. 3. Team-based intellectual power. A collaborative environment where bright minds analyze, challenge, and execute strategies together can create a significant and sustainable advantage. 4. Information superiority. Relentlessly seek and efficiently process information to gain an edge, whether through technology, analysis, or market insight. 5. Masterful risk management. Employ highly sophisticated and dynamic risk management techniques, especially for options, to control exposure and protect capital, even when dealing with complex strategies. 6. Continuous learning and adaptation. Markets evolve, and so must trading strategies. There's a constant need to refine models, learn from outcomes, and find new edges. 7. Humility and objectivity. Maintain a disciplined, objective approach, free from emotional bias, and always be willing to admit when your model or strategy is not working. Part 7. Chapter 21. The Psychology of Trading. This chapter is a powerful synthesis by Jack Schwager, drawing together the crucial psychological lessons and recurring themes from all the interviews conducted throughout the book. It's not an interview with a new wizard, but rather Schwager's distillation of the mental and emotional traits that differentiate consistently successful traders from those who fail. He argues that while strategy and market knowledge are important, psychological mastery is arguably the most critical determinant of long-term success in trading. Schwager highlights that traders often fall prey to common psychological pitfalls: fear and greed. These primal emotions lead to cutting winners short and letting losers run, the antithesis of profitable trading. Overconfidence and ego. After a string of wins, traders can become arrogant, take on excessive risk, or ignore their own rules, leading to significant losses. Stubbornness. The inability to admit being wrong and reverse a losing position is a direct path to ruin. Hope. Clinging to hope that a losing trade will turn around rather than acting decisively. Lack of discipline. Failing to adhere to a predefined trading plan and risk management rules. In contrast, the market wizards consistently demonstrated absolute discipline, sticking to rules even when emotionally difficult. Unwavering risk management. Prioritizing capital preservation above all else, cutting losses quickly and mercilessly. Probabilistic thinking. Understanding that any single trade is uncertain, and focusing on the statistical edge over many trades. Emotional detachment. The ability to treat trading as a business, not a personal quest, and to separate ego from trade outcomes. Humility. Acknowledging the market's supremacy and one's own fallibility. Adaptability. Being willing to change one's mind or strategy when market conditions dictate. Self-awareness. Understanding one's own psychological weaknesses and building systems or habits to mitigate them. Schwager concludes that successful trading is largely a battle against oneself, and cultivating the right mental framework, discipline, and emotional control is essential for sustained profitability. Key takeaways. 1. Psychology is paramount. Trading success is primarily determined by psychological fortitude and discipline, often more so than by intellect or specific strategies. 2. Cut losses ruthlessly. The most common and devastating psychological error is letting losses run. Successful traders accept losses quickly and move on. 3. Discipline. Over emotion. Adhere strictly to a predefined trading plan and risk management rules, overriding impulses of fear, greed, or hope. 4. Probabilistic mindset. Understand that trading is a game of probabilities over a large sample of trades. Individual trade outcomes are largely random. 5. Remove ego from trading. Detach personal ego from trade outcomes. Being wrong is part of the business. Admit mistakes quickly and objectively. 6. Humility and adaptability. Always respect the market. Be humble enough to change your mind and adapt your approach when conditions dictate. 7. Self-awareness. Identify your own psychological weaknesses, e.g., overconfidence, fear of missing out, and implement safeguards, e.g., systems, rules, to mitigate their impact. 8. Trading as a business. Treat trading as a rigorous business endeavor, focusing on process, risk control, and long-term consistency, rather than chasing quick riches or emotional gratification. Part 8. Chapter 22. Closing Bell. Closing Bell serves as Jack Schwager's final reflections and summation of the profound lessons gleaned from his conversations with the market wizards. It's a concise epilogue that doesn't introduce new concepts, but rather reinforces the overarching themes and enduring truths about trading that he observed consistently among the most successful participants. Schwager reiterates that while the specific strategies and market focus of his interviewees varied wildly, their success was almost universally underpinned by a few core principles. He emphasizes that risk management is non-negotiable. Consistently protecting capital is the bedrock of long-term survival and profitability. Discipline is paramount. Adhering to a well-defined plan, especially regarding risk, is crucial, even when emotions compel deviation. Self-awareness and psychological control. Understanding one's own weaknesses and building systems to counteract them is vital. The market is always right. Humility and the willingness to admit being wrong quickly are essential for longevity. Continuous learning and adaptability. The market is dynamic, and traders must constantly evolve their understanding and methods. He leaves the reader with a powerful message. Success in trading is achievable, but it demands an extraordinary level of dedication, mental fortitude, and a commitment to perpetual self-improvement and rigorous discipline. It's a challenging path, but one where the rewards can be immense for those who master themselves as much as they master the markets. Key takeaways. 1. Reinforcement of core principles. The closing bell reiterates that the fundamental keys to trading success are consistent across all market wizards: stringent risk management, unwavering discipline, and robust psychological control. 2. Trading as a life journey. Schwager implies that mastering trading is a journey of self-mastery, requiring deep introspection and continuous personal development. 3. No single holy grail. The book concludes by emphasizing that there isn't one secret strategy, but rather a set of timeless principles, primarily behavioral and risk-oriented, that lead to success. 4. The challenge and reward. Trading is inherently difficult and demanding, but for those who commit to the necessary discipline and psychological work, the potential for reward, financial and personal, is significant. 5. Practicality. Overtheory. The ultimate message is that successful trading isn't just about intellectual understanding, but about consistent, disciplined, and pragmatic application of sound principles. Today, we're diving into a legendary work that pulls back the curtain on the minds of the world's most successful traders. The New Market Wizards: Conversations with America's Top Traders, by the renowned Jack D. Schwager. Have you ever wondered what truly separates consistent winners from everyone else in the markets? Do you long to understand the real secrets behind managing risk, mastering your emotions, and developing an unbreakable trading discipline? Jack Schwager reveals that true trading success isn't just about strategy. It's profoundly about mindset, an unwavering commitment to risk management, and the psychological fortitude to navigate relentless market challenges. We'll explore the invaluable wisdom of these trading legends, from their approaches to risk and discipline, to their unique insights into market behavior, and the critical psychological traits that enabled them to achieve extraordinary results. Get ready to gain a rare glimpse into the strategies and, more importantly, the minds of those who've truly conquered the markets. So, if you're ready to unlock the secrets of trading mastery and forge your path to financial success, hit that like button, subscribe to PowerBooks if you haven't already, and let's unlock our new destinies. All right, that brings us to the close of our deep dive into The New Market Wizards: Conversations with America's Top Traders by Jack D. Schwager. We've journeyed through the profound insights and hard-won wisdom of the trading world's most consistent performers. Remember, the true magic of these market wizards isn't in secret strategies, but in their unwavering discipline, their meticulous approach to risk management, and their incredible mastery over their own psychology. You now understand that consistent trading success is a battle fought within, demanding emotional control, humility, and an unyielding commitment to your process. But here's the truth. This summary is just the tip of the iceberg. Jack D. Schwager's The New Market Wizards is an invaluable, in-depth collection of real-world lessons, a meticulously crafted manual for understanding what it truly takes to succeed in the markets. If you're serious about developing a disciplined trader's mindset, mastering risk, and applying the timeless principles of these legends to your own financial journey, then owning this book is not an option. It's an absolute necessity. This isn't just a book. It's a blueprint for your ultimate trading transformation. Do not miss out on the full, life-changing experience. Secure your copy of The New Market Wizards right now through the link in the description below. As we always say here at PowerBooks, knowledge is not power. The application of knowledge is power. So take these revolutionary insights and begin the profound work of cultivating the mindset of a market wizard. If you found this breakdown valuable, please give this video a like, share it with anyone ready for a massive shift in their trading, and make sure you're subscribed to Power Books for more deep dives into paradigm-shifting books. Don't forget to hit that notification bell so you're always first to empower your journey. Thanks for tuning in, and until next time, keep learning, keep growing, and keep creating your greatest self